The US dollar is down against every G10 currency since President Trump's inauguration on January 20th by as little as 3.5% and as much as 16%. Crucially, the US dollar has weakened, listen to this, much more versus gold. But as you can see here, we made an all-time weekly closing high in gold yesterday. And it looks like this consolidation could be over, and that's why I think what we're going to see now is similar to what we saw from January to mid-April, and gold could go up around $700. So you take 3,300 plus 700, you get around 4,000. And that's why I think we could go there.
The evidence suggests that the prevailing market environment, beginning slightly before and continuing through the Trump administration, has been characterized by a weakening U.S. dollar. Global expert Mario Innecco forecasts that gold could reach $4,000 by mid-October 2025, drawing from technical patterns similar to its sharp rise earlier this year. If the trend repeats, Innecco expects a potential upward move in the months ahead. The rally in gold remains impressive as the metal has rallied by as much as 76.4% from the lows of last February. There's only been a brief pause along the way, such as the bull pennant that formed around the presidential election in the fourth quarter. From a technical perspective, Innecco challenges Treasury Secretary Scott Bessent's claim that the dollar isn't weak, calling it misleading. He cites a Sherwood. News articles show the dollar has dropped against every G10 currency since Trump's 2025 return. According to Innecco, gold has moved dramatically from under $90 in 1973 to over $3,360 today, while the dollar index has barely moved in 5 decades. One of the most alarming forces sealing the fate of the world's fiat currencies is the explosive growth of global debt, reaching an estimated $224 trillion. This towering debt burden is the ticking time bomb, ultimately bringing fiat currencies to their knees. Regarding silver, Innecco notes a breakout above $35 as a key technical trigger, as it remains undervalued with a gold-to-silver ratio near 100 to 1. Silver is not your typical market in the sense that it's relatively small to many other assets, including gold. The total global market cap for silver is only about $1.9 trillion. In comparison, gold's market cap is nearly 12 times silver, at approximately $22.3 trillion. Before diving into Mario Innecco's sharp insights from his latest interview, hit that subscribe button and tap the bell icon so you never miss a moment when truth meets the markets. Let's get into it.
I saw some comments from Bessent. One was that the dollar is not weak, he said, against the other currencies. He said it's the other currencies that are strong, which is a bit misleading because, yeah, it doesn't make any sense. But I wanted to show you, and I'm going to show you later, a chart comparing the dollar index to gold since the inception of the dollar index in 1973. And before we do, though, I found a really good article. I've never heard of this blog. It's called Sherwood.news, but they had a really good article, fresh article on this Bessent comment. And it says, "Sorry, Treasury Secretary Bessent, it sure looks like we're living in a weak US dollar world." So let's go through it. It says, Treasury Secretary Scott Bessent made an interesting statement to Bloomberg's David Weston earlier this morning. That was yesterday, Friday, the 23rd, when asked about trends in the US dollar. That is, trending lower for those who might not have been paying much attention. And this is Bessent saying, this is a quote from Bessent, "On many of them, I wouldn't necessarily characterize it as a weak dollar," he said. "I think a lot of this is other countries' currencies strengthening as opposed to the dollar weakening." Well, the writer of the article says, of course, everything in currency markets is relative. A fraction requires a numerator and a denominator, but there are ways to try to tease out whether this is a case of other currencies being strong or the US dollar being weak. And the evidence points to the idea that the market regime we've been in during the Trump administration, and a little before that, to be more fair and precise, is that of a weak dollar. The US dollar is down against every G10 currency since President Trump's inauguration on January 20th by as little as 3.5% and as much as 16%. Crucially, the US dollar has weakened, listen to this, much more versus gold, the classical alternative currency store value that it has against anything else. So he's saying, yeah, the dollar has depreciated a lot more versus gold, and that is a weak dollar, and that is devaluation. The only way to devalue really is via gold. But the other thing I would say is that these devaluations come and go. Some countries will devalue quicker at some point, and this is the US's turn. And this article brought up a really good chart. It says this is what plain old US dollar weakness looks like. So percentage change in US dollars since Trump inauguration. So they've got the blue line is the euro, the red is the yen, the purple is the Swiss franc. Look at how gold is really outperformed all the other currencies, and that's why gold is also up in terms of other currencies. So other currencies are also being devalued, which sounds doesn't sound right, but versus gold they are. I said I wanted to bring up a chart of the dollar index and gold back to 1973. The dollar index was created and it started being measured in 1973, March 1st. And the reason they did that is because the dollar system, the Bretton Woods system, collapsed. And instead of having a fixed exchange rate regime, we went into a floating rate regime. So the dollar had, this index measured the dollar versus the major currencies. At the time, they were the legacy European currencies. Now the euro makes up like almost 2/3 of this index. But the reason I wanted to show you this is because it shows how true devaluation works. It's not against the other fiat currencies, it's against gold. And this chart here proves it, because in March of 1973, the dollar index started at 100. And yesterday when I drew this chart, it was at 99.16. So an insignificant drop, basically in 52 years. While gold was trading under $90, and yesterday it was, when I drew this chart, it was at 3,360. So that's how they do it. And that's why they don't want the public in gold, because you protect yourself and this whole Ponzi fiat currency system would end. So yes, if you really want to destroy your savings, hold on to fiat dollars, fiat pounds, or whatever. Buy government bonds and keep cash in the bank. Yeah, that's what this is telling us. So now I want to talk about why gold could go to 4,000 by the middle of October. And I don't really like making forecasts, but sometimes, yeah, I'll stick my head out there and do it. And the way I've done this is looking at the past, at this weekly chart, going back to the beginning of the year. And we started the year around 2,600. And we went up almost in a straight line. Yes, there has been a bit of volatility, but by the middle of April, gold had reached 3,357. That was the high. So let's say from 2,600 to 3,300, $700. And ever since middle of April, though, we've been in a consolidation, pretty choppy, basically between 3,200 and 3,350. But as you can see here, we made an all-time weekly closing high in gold yesterday. And it looks like this consolidation could be over. And that's why I think what we're going to see now is similar to what we saw from January to mid-April, and gold could go up around $700. So you take 3,300 plus 700, you get around 4,000. And that's why I think we could go there. As for silver, the chart also looks pretty bullish. Yes, we're right around that 100 to 1 gold to silver ratio, still really high, but the key level in silver is really clear, and the bullion banks are gonna, they're gonna protect this level to the death, so to speak, and it's 35. But once we break 35, I think we could see a major move higher very quickly in silver, and I expect silver to catch up and overtake gold eventually.
In the interview, Mario Innecco emphasizes how even major institutions like Deutsche Bank are entertaining the idea of a 40% US dollar devaluation, suggesting it could eliminate the trade deficit. He references Vince Lancey's comment that such a drop could also wipe out rehypothecated gold shorts globally. Deutsche Bank believes that while there are more effective and less painful alternative paths to address the trade deficit, this preferred path may currently be politically unfeasible. However, the report anticipates that as the negative economic effects of the current tariff-focused policies become more apparent in the coming months, public pressure will drive policy changes. According to George Saravelos, Deutsche Bank's global head of FX strategy, the dollar is at risk of losses whether the U.S. government experiences a fiscal crisis or a recession. Following rising fiscal desperation, Innecco flags Australia's proposal to tax unrealized pension gains as a sign of creeping wealth confiscation. He views this as part of a broader global shift, where governments subtly seize wealth through taxation and currency debasement. Let's get back to the interview.
Like Deutsche Bank, for example, are saying things like 40% dollar drop could erase U.S. trade deficit. That's Deutsche Bank. And erase rehypothecated shorts from planet Earth. That's VBL Ghost, or Vince Lancey, who said that, and he's talking about the gold shorts. And I replied to that, and I said, and turn the U.S. into a candidate for third world status. So I'm not saying the U.S. wants to devalue by 40%, but the fact that Deutsche Bank is talking about it is something that is probably out there. Just one more story that I saw that I think might be interesting for my viewers in Australia, and I'm sure you know about this, is the fact that the new Labour government there is thinking of putting a unrealized capital gains tax on supers. Supers are just the private pension system in Australia. Everyone's that works. This would be for accounts with over 3 million Australian dollars. So how it would work is if you start the year with 3 million and by the end of the year it's at 3,300,000, you've made 10%, they will tax you on that 300,000. So you're going to have to send a big check to the taxman there. So it's a wealth tax, but this is just like a probe. I would say it doesn't mean they're going to do it, but it just goes to show that Australia, the UK, even the US, the EU, these governments are desperate for revenue, and they're going to do whatever it takes to take your wealth away, because governments, of course, don't have any money. And I do have to admit, maybe the Trump administration isn't as blatant, but that's what devaluation and debasing the currency is, the same thing. It's a kind of wealth confiscation on the sly. Very few people notice. I think it was, inflation is something that very few people understand. Only 1 in a million do, and it's a way to basically destroy the bourgeoisie, and that's what's going to happen, unfortunately, with these continued policies.
Crucially, the US dollar has weakened much more versus gold, the classical alternative currency store of value, than it has against anything else. Gold is gaining prominence as a reserve asset due to a weak US dollar and declining US financials, reaching record highs while equities and bonds fell. Are you positioned to benefit if gold reclaims its role as the world's ultimate measure of value? Drop your thoughts in the comment section below. If you find this video informative, don't forget to support our channel and turn on notifications to stay informed about our latest videos. See you in the following video.